Market fluctuations are your friend, not your enemy, right? We've seen the volatility in the market in the last couple of weeks. Shouldn't be scared. Shouldn't be your enemy, should be your friend. So in this video, I want to touch on 4 stocks under $100. Of course, under $100, the list goes on and on and on. So it's under 100, over $20, because the next video will be about, well, stocks under $20. And by the way, just because a stock is under $20 or under $100 does not make it expensive or cheap. Yes, it is cheaper to buy, but the company itself, the stock that you're buying, can be expensive at $100, can be cheap at $300. It's all about valuation and pricing. And as always, I'm not here to waste your time. These are the 4 stocks that we're going to cover in this video. I hope you keep watching, and if not, at least leave me a like and a comment. Thank you very much. And before we continue, if you enjoy this type of videos, give it a thumbs up, subscribe if not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So, company number 1 I want to touch on is Uber. Now, Uber is the only one on that list that I own personally. I've added Uber towards the end of 2024, added more towards the start of 2025 as well. Currently, Uber year to date is actually up 20%. So despite a lot of volatility in the market, this stock, among other stocks as well, is actually up year to date. Now, Uber has a market cap of $159.3 billion, a forward PE of 30.8 times. On a GAAP basis, on non-GAAP, it's a bit lower than that. Still expected to grow revenue around 15% at the midpoint for the next coming fiscal years. Free cash flow is expected to grow around the same, actually a little bit faster more recently. But of course, with Uber, a lot of the questions are around, oh, can they survive the autonomous wave? I think they can. I think they'll be the platform in the middle. I think there will be plenty of players and a lot of them will be listed on the Uber platform because they have the distribution. You want a high utilization rate. Where do you get that? You get that from Uber. Of course, can be wrong. And maybe Waymo and Tesla dominate 99% of the market, and that will be an issue. Yeah, that's definitely a scenario you have to consider. Now, right now, the average analyst price target is 16% higher than the price we're at today. It's around $90 or so. If we look at the expected growth for this company, like I said, revenue is expected to grow quite nicely, around 15% or so at the midpoint. Free cash flow, a bit faster than that, as you can see, for the next coming fiscal years. Now, how does Uber generate revenue? Well, 3 segments: mobility, delivery, and freight. As you can see, that's the smallest part, although we have seen a huge, increase here in 2022. The others, delivery and mobility, those are the 2 largest segments, with mobility being the largest one. And if we look at the growth rates, the compound annual growth rate since 2019, so you're taking here the impact of the pandemic as well, mobility has grown at the compound annual growth rate of 18.5%, delivery 57.8%, and freight 47.7%. If we look at total trips, that has increased at a compound annual growth rate of 10.3%, including that negative impact from the pandemic, and monthly active platform customers have increased at a compound annual growth rate of 9% since 2019, or 54% from 2019 all the way to 24. Zooming out a little bit, looking at gross profit margin, as you can see, has been around 33% or so for the last couple of quarters. And then looking at free cash flow margin, that has consistently been improving. So that's what you want to see. And I think that's what we're going to continue to see. Now, of course, the big question, like I said, is about autonomous vehicles. Can they survive that? Well, they showed us this slide last quarter. Uber is well positioned as a VTech that advances, with several partners added already. So we've got Waymo, WeRide, Pony AI, Aurora, Wave, AV-Ride, NVIDIA is a partner, strategic partner as well. And then potential partners, you've got Zoox, that's from Amazon, Mobileye, Tesla, although we've heard more recently that they had conversations and Tesla wants to go alone, which, okay, they'll probably succeed, but I think eventually you'll see plenty of Teslas on Uber's network, just like you're seeing them today. Uber itself has also various investments in a lot of autonomous vehicle companies, so if they're successful, Uber will be successful as well, and you can already imagine that as they scale up, they'll get listed on the Uber network, so win-win. Moving on to company number 2, and that's a company you've been asking about for a while, especially since it took a huge hit more recently, and that's the trade desk. As you can see, the trade desk year to date has seen a drawdown of close to 50%, especially after their last earnings report, which was a rare miss. I mean, it was the first miss in 8 years, believe it or not. Right now, it has a market cap of $32.2 billion, a forward PE of 36.4 times. EPS, if you look at the next 2 years, should grow at around 15%, for revenue closer to 19.3%. Currently, the average analyst price target, yes, after the hit and after the, re-rating, it still sits 75% higher than the price we're at today. Now, last quarter, this was basically it. Nice summer here by Brad on X. Missed revenue, missed the guide, missed EBITDA, missed GAAP EBIT. Also Q1 guide did miss. So definitely not a good quarter by the company. A rare miss, right? A rare miss, like I said, first miss in 8 years. They also said that in December, they undertook a reorganization to accelerate opportunities across CTV, which is connected TV, retail media, identity, supply chain optimization, and audio, while forging ahead with innovations like Kokai and the Ventura operating system. There were also some delays with regards to the release of Kokai, so that has impacted the revenue. But they said, look, we could have released it and looked at, okay, now we're going to get a little bit more revenue, but the product is not as perfect as we want it to be. So there was a delay there. There's also, like they said, reorganization. They said that they lack, I would say, elite executives at the company. So they're trying to get more of those, reorganize a couple of groups inside the company to take advantage of, the long-term growth potential of the market that they're playing in. And the market that they're playing in is a pretty big one. The open internet is a $935 billion plus market and getting bigger. So you've got traditional media, search, social, video, audio. I mean, this market is going to go towards that $1 trillion market. The Trade Desk, a very, very big player in that, and they want to take more and more share of that overall pie. Looking at the expected growth rate for free cash flow, as you can see, free cash flow is expected to grow 20-22% or so in each of the following fiscal years, with revenue growing around 15-20% as well. Looking at total gross billing, so as this continues to go up and up and up, they still manage to grow it at around 24% or so each and every year. And then zooming out, gross profit margin around 81% or so. Free cash flow margin was a bit higher previously. More recently, in the last couple of quarters, it has taken a hit, although we've seen a small recovery since Q2, and they expect that to continue in the future. So yeah, in my opinion here, of course, huge hit, right? Huge hit on the stock in just a short period of time. If you like this company, if you like this industry, which is the advertising side, especially on the buy side of things, Trade Desk is the best name out there, all right? It's not the cheapest one, but it's a world-class company, world-class management. One bad quarter in 8 years, I don't think breaks a thesis. Just makes the shares look much cheaper. Moving on to stock number 3, and that's Hims & Hers. And here as well, we can see a drawdown of 47.7%. Right now, it has a market cap of just under $8 billion, a forward PE on a GAAP basis of 55.3 times. But here you can see that the expected growth rate for the next 2 fiscal years, very, very high, 34.2%. EPS, that same period, sits closer to 30%, 28.7% to be more specifically. But of course, with this one, you always get a hit. We can actually see this in the price, right? We went up quite a lot. I think there was also a short squeeze there because short interest was quite high. I think it still is higher than, the norm. But then, since it peaked at around $70, it got hit. There is a lot of volatility around this name because of GLP-1, compounded for them more specifically, whether it's headlines about shortages, non-shortages, can you continue with your compounded solution, yes or no? It affects a company like this, although it's just around, 15% or so of revenue, which is much more than what they had last year. But when you look to invest into Hims, you invest in the whole platform. You don't only invest in the weight loss segment, you invest in sexual health, dermatology, mental health, and of course, future solutions. So you invest in the Hims platform, not just in the GLP-1 segment of the business, which of course gets the most attention because it is a market that is growing quite quickly. There's a lot of money to be made there. Yes, it is quite controversial to look at the compounding solution. You basically steal years and billions of dollars of research from Novo Nordisk, Eli Lilly, and then you come out with your own and say, oh, okay, actually, this is the solution. I understand why the other side is quite angry at this. So yeah, but with HIMSS, you invest in the whole platform. That's the thing. If you only invest in it for GLP-1, well, just look at Novo Nordisk or Eli Lilly, which, by the way, Novo Nordisk could have been on the list because it's also under $100. Looking at the average analyst price target, that sits 20% higher than the price we're at right now. And here as well, you can see that the expected growth rates for free cash flow, quite good. 30-35% or so in each and every fiscal year. Not too bad in my opinion. Looking at how the business has performed the last couple of years, net orders keeps on increasing, average order value keeps increasing as well. Looking at number of subscribers, that's over $2.2 million as of last quarter. Online revenue is the majority of the revenue, $1.437 billion. And then you have wholesale revenue, small part here, $38.6 million. Zooming out, we can see gross profit margin of around 80% or so. Looking at free cash flow margin, that has of course improved quite a lot, especially in the last 2 years or so. And I do expect that to continue. So all trending in the right direction. Yes, gross margin here, gross profit margin has taken a small hit from the peak of around 82.4. Should be staying above 80% in the future. But of course, with this name, there's always going to be headlines until this whole shortage issue, GLP-1 compounded issue is solved. You're going to see those headlines that could provide long-term investors with opportunities to buy back lower. I know the stock is down almost 50% from its peak, but it also went up quite a lot in a short period of time. The business continues to perform quite well. Like I said, you invest in the HIMSS platform. Moving on to the next company and the last one, and that's Robinhood. Now, Robinhood as well has seen a little drawdown of 32% this year, but I mean, all in all, in the last year or so, this stock has done quite well, right? In the last year, you can see it went from $16, $17 to now $44. Very, very good. I started to talk about Robinhood under $10. I did own it under $10 up until $17 because in my head, this was just a trade. I saw the disconnect. Now, if I can go back, I'd probably tell myself, hold it, don't trade it. And I know I'm saying this now in hindsight, but at $17, it was still doing quite well. There was still a lot of momentum with the company. It's just that my plan was to just trade it. So yeah, I more than 2x'd. That's great. Could have done more, of course. Anyways, market cap here of $39.3 billion. Forward P on a gap basis here, 31.3 times. Expected growth rates, and this is where things are a bit tricky. So for revenue, the expected growth rate in the next 2 years, 17.1%, that's fine. EPS, a decrease. Why is that? Well, first of all, different tax rate. Second of all, the analysts are expecting, well, if there is more volatility, because this is, let's face it, at the moment, a cyclical business. If there is not enough activity in the crypto market, in the equity market, they take a hit at the moment. Of course, in the future, that might change. They're really focused on attracting more and more traders. So even if the market goes down, traders doesn't really matter, right? Because traders will trade no matter what. So you want that volume to come to the platform. And then, of course, lots of other things should be coming to the platform. They also have that subscription model with the gold members. So that should tackle the cyclicality issue. They have retirement accounts, etc., etc. So they're definitely diversifying the business. Now, at the moment, the average analyst price target sits 55% higher than the price we're at today. Looking at the business itself in the last couple of quarters. So you can see that last quarter, they got a huge increase here in cryptocurrency revenue that comes from transaction-based revenue. Options revenue was about the same as the last quarter, a bit better. And then equities is still quite small. So all in all, what you get is the majority here comes from transaction-based revenue. You still have a nice chunk that is coming from net interest revenue. So overall revenue for last quarter, first time above $1 billion. Of course, a big push thanks to crypto. Now, what's interesting here is that, of course, when you look at monthly active users, that has peaked back in the pandemic highs, 21.3 million. Since then, it has come down, although last quarter we did see it go up a little bit. But even with less monthly active users than before, you can see that total asset under custody continues to go up and up and up. Deposits keeps on increasing, and well, that's the power of Robinhood right now. So it is a cyclical business, but as they get more and more money into that ecosystem, as they release more and more products, I think the cyclicality will hurt them less. When we will eventually go in maybe a bear market, I don't know when that's going to happen, if that's going to happen anytime soon, and we might be getting back to those levels right here, which was not good at all. Having other products that don't rely on whether it's a bull market or a bear market will definitely help a business like Robinhood. And as they expand internationally as well, as they launch in new countries, I think that will just make the platform and the business stronger. I do like it a lot. If it were available to me, I would probably be using it right now. So all in all, those are the 4 companies, those are the 4 stocks I wanted to touch in this video. If you have any other ideas, let me know down in the comment section below. Like, comment, subscribe, and I'll see you all in the next one. Bye bye.